Well, good evening, everybody. It's now just after 5:30. Welcome to the Tern Investor Webinar. My name is Tim Metcalf. I'm Managing Director of IFC Advisory, Tern's recently appointed new financial PR and investor relations advisor. We're delighted with the response to the webinar this evening, and we've got over 100 attendees, and we thank everybody for joining us. Some of you we know will know Tern well and have been shareholders for some time. Others are more recent shareholders, and particularly there's one or two who've been in touch who've recently joined the register through the primary bid offering. And I'm also aware that there are a couple of prospective shareholders, if not more, who are joining us. So we've tried to design the presentation to be suitable for everybody. We also thank everybody who's submitted questions and comments ahead of the event. These have all been looked at and have really helped us to shape the presentation. So hopefully you'll find that the vast majority of your questions are asked during the presentation that Al and Sarah will be giving. But if they aren't, we do have the opportunity at the end of the presentation for questions and answers. Given the number of attendees, it's not going to be possible to go to people individually, but we would ask you to use the Q&A button at the bottom of your screen. You can type in a question, they'll be seen by me, and I will do my level best, dependent on time, to get through those at the end of the presentation. So without further ado, I will hand over to Al Sisto, CEO of Tern, and Sarah Payne, the CFO, to take you through the presentation this evening. Al.
Well, thank you, Tim, and good evening to everyone. We really appreciate the interest, and hopefully we'll fulfill, as Tim said, with information today that provides some clarity and insight into the questions asked, as well as into what we do at Tern and how we create shareholder value. I also will apologize in advance to our long-term holders because some of the information may be redundant, but I think we have some additional news today that will provide some further insights for everyone, and think that would be helpful in the grand scheme of providing this update to you in November on our activities. So let's move through the disclosure slide and onto the vision. And I think it's important for us to really bring forth the idea that the vision here at Tern is really to provide a unique investment vehicle for our shareholders to gain access to disruptive IoT companies, particularly companies at their early stages that have not been really exploited, but can be and will be market leaders in the categories that they're participating in. And I think our vision is to really work with these companies early days to create shareholder value and unleash that shareholder value over time, and then potentially through an exit, where that exit is comprised of either a trade sale or potentially an IPO, given the nature of the business and the opportunity created by the business. I think first, I think it's important to talk about the people in the company, and this is a company that is small by staffing perspective, but large in terms of the years of experience and the intellectual capabilities brought to the business by the individuals. Bruce and I are the two founders, that helped start this business, and we're both operating guys who have run businesses both in the U.S. and outside the U.S. Have been investors, professional investors, working with venture firms, and as well as working on our own as angel investors. And our two non-executive directors are long histories in the UK marketplace, with Ian Ritchie having participated in over 40 startups, of which one was his own, which he sold to Panasonic, and Alan Howarth, who has been a non-executive director since retiring from EY, with a heavy emphasis in the national health system and businesses that are related to providing healthcare and healthcare products to the marketplace, and introducing our newest investment director, Matthew Serba, who again brings a wealth of experience, both from a technical engineering perspective, as well as having been a CEO and participating with venture organizations in his career. So we have a group of people with over 100 years of experience, with probably more than 100 transactions in the public-private, private-public sectors, that are bringing forth the opportunities to you. But I would like Sarah to just give her background, because she presents what I believe is an important aspect to our business, with her investment acumen, but also her FP&A prowess. Sarah?
Thanks, Al. Thanks. Hi, everybody. So I've been with Tern for 5 years, and I really started off with Ernst & Young and qualified with them quite a few years ago now. I spent 6 years with them, 3 years in with qualifying, and then another 3 years in corporate finance. And then moved from there into the BBC, which gave me both commercial strategy experience, but that was where I started a lot with my FP&A, actually running the BBC budget. And then they spent quite a few years, 7, 8 years then, working with high-tech companies, high-tech startup businesses, and supporting them through their growth and development, which made the transition into Tern a really obvious and and a really rewarding one for me as well. So
thank you, Sarah. And again, I just want to point out that the management team, the board, we are all shareholders in the business, so we are aligned succinctly with you all as shareholders through the public markets. So let's review our current portfolio status. And I think part of our portfolio strategy is revolving around creating synergies between these companies to trade ideas, particularly in areas of technologies, but also in go-to-market strategies. And I'll try to illuminate some of those synergies through the discussions of these companies as we move through the list. I'd like to point out that we look at this business as having 5 principal portfolio companies. These are the top 5 on the list here, and 1 minority investment. And I'll quickly talk about Push Technology, the minority investment where we have less than 1% invested. And that was created in the early days of the formation of Tern to qualify to be an investment company listed on AIM. And it is a company that's making great progress with a recent investment from Maven Capital and progressing in a pretty unique marketplace, and we're looking to this with some hope and promise to create a realization sometime in the future. But focusing on our principal portfolio companies, I'd like to first talk about Device Authority. Device Authority is our flagship business, our first real investment, and an investment where early days the strategy of Tern was to buy or acquire all the assets of a business, with the idea to work with the company, turn the company around, build infrastructure, and grow the business and bring it to market and hope for a trade sale. We changed this strategy in 2017, really to look at the risk profile and create capabilities within the portfolio to mitigate risk and to maximize additional resources available to our companies to help them grow. So at this point, Device Authority is a business that has Alsop Louis Partners, a major Silicon Valley venture firm here in the peninsula in San Francisco, as a co-investor, as well as the Samanek Family Trust. George Samanek took an interest in Device Authority early on. George was the former CEO of McAfee and was one of the leading executives at IBM before that in his career, and was a personal investor in this business. He passed, and his family continues to support the investment. But Device Authority is really focused on providing capabilities to enable the hybrid cloud as a backbone for using IoT devices connected to applications. And the principal product or the principal service they provide is for secure lifecycle management of devices. If you think about your Apple phone, you're probably on your 4th, 5th, or maybe 8th Apple phone since it came into existence. But on your Apple phone today are some of the same applications that were installed on your existing Apple phone, your first one that you used. And the idea of being able to securely move and control and provide the necessary capabilities to protect both the devices and the applications that use the devices is what Device Authority does. And it's partnered with companies like Wipro, but more importantly with Microsoft, in supporting the Azure Cloud program that they've put together through two areas that are part of the onboarding process and the continuous management of products that are using the Microsoft hybrid cloud. And that's the Sphere product and the DPS product from Microsoft. So Device Authority has built a business around a product called Keyscaler. Keyscaler does this secure lifecycle management, and it has a very unique capability in providing both the ability to deal with old existing devices, as well as provide a higher level of capability for new and more modern devices. So the investment management of the customers of this product is really well protected in terms of future-proofing what they do, as well as protecting what they have. And we're excited about this company in particular because it's developing a SaaS model where it's increasing its MRR as more deployments are put into the marketplace. Our second portfolio company on the list here is Fundamental VR, and Fundamental Virtual Reality is a surgical support product that has been implemented to provide for the capabilities to replicate in as realistic an environment a surgical procedure where the target market and the pain that is being addressed in the medical industry by Fundamental is all about being able to bring new devices and new capabilities, surgical capabilities, into the marketplace, where companies who develop these procedures, these pharmacological products, and/or these new devices are now, particularly in the era of COVID, struggling with the ability to train and have replication and provide human factors sort of approvals for their products in the marketplace. Fundamental, with its unique platform, provides these companies with a capability to create training programs, marketing programs, and realistic surgical procedure practice programs for their products in the marketplace, with a very key differentiator over other things in this space, with this haptics capability. And the haptics capability is all about the ability to actually feel the tissue, the bone, the whatever the procedure requires, to allow the surgeon to experience that and replicate it in their own theater, if you will, and create this capability that they can practice over and over again until they feel satisfied with the product and satisfied with the procedure as something to adopt. We believe this is going to be the new way that products come to marketplace, into the marketplace, and get adopted. And these adoptions are products that are taken on by the surgeons, really provide incredible revenue possibilities for these businesses and spin-ups and earnings. So we're providing through Fundamental this capability to deliver surgical procedures, as well as to accelerate revenues and earnings for the companies that use that. And I'm pleased to announce today, and we'll issue a reach tomorrow morning, that they've secured yet another order, and it's important because it's a follow-on order from one of their customers for additional procedures to bring some products to marketplace. So we're excited about the performance that is happening at Fundamental. We're also using this as an example of how we've now syndicated deals, and from a syndication point of view, what we talk about in syndicating our portfolio companies is bringing in new investors, both financial and strategic. And in the case of Fundamental, we went into this business early, helped the management team craft the strategy, and then with the strategy and some proof points and execution, we're able to bring in companies like Downing Ventures, a UK well prestigious venture capital organization, as well as strategic investors, the Mayo Clinic and the Sana Hospital Group out of Germany, which are premier surgical organizations whose process and procedures are replicated around the world. So Syndication is important in our portfolio, and Fundamental is a great example of doing that. And in doing so, we were able to, again, bring an uplift in our net asset value of over 27% as part of that syndication. NVMA is one of our early investments, and NVMA was an investment in a company that we saw great promise in terms of creating templates for products, as they are a 20-year-old engineering company whose founders saw the opportunity in IoT and worked to create an industry 4.0 business, bringing capabilities through their partner PTC into the marketplace. And we're pleased that we're now with a new CEO and expanding the management team, who brings great product backgrounds in terms of product-led businesses. And we have a product, Asset Minder, which we believe is revolutionary in the marketplace in terms of providing condition monitoring of platform manufacturing lines, oil refineries, oil platforms, such that problems can be addressed before problems become game-changing issues for those organizations. And NVMA is making great progress and has now an industrial partner and a distribution partner for this product that will help us and help them create value and deliver this around the world. And we're looking forward to NVMA performing in this new product role. And this shift that we expected and helped develop from a services business to a product business also gets reflected in terms of the multiples. When I say multiples, I mean how acquisitive organizations look at the business. A services business is generally about 1x revenues in terms of value, but a technology business with a product can be anywhere from 7 to 10 to 25x revenues, depending upon the acquirer's need to change their business model or accelerate their revenues. So we're really excited about the progress that NVMA has made, and again, we'll see this continue through 2021. Wild Networks is one of our companies that we actually created from the exit of one of our businesses and the acquisition of some other businesses that we thought would together create a capability to address a real need that's a worldwide need, and that's all about providing internet access to where it's not generally available, or where the internet access is congested, and the capabilities to use or create the promise of the internet has been impeded. For example, in large stadiums, Wembley, when it's full, it's very difficult to get real internet access, for example. And in the farmlands, as close as Wiltshire, for example, we're talking about 3G access and nothing available in the field to implement precision agriculture. So what Wild is a hybrid networking company that takes into account LoRa, low power radio waves that are generated through beacons or through satellites to provide internet access to precision agriculture machines in the fields, for example, is one implementation, or in combination with the mesh technology, which is the localized capability, provide access to distinct individuals or distinct machines or devices, such that internet access, data sharing, and data curation can be established. And Wild Networks has recently, through the Scottish government, implemented a program for care home monitoring or care home monitoring and tracking. And I'm happy to say that that is progressing. The installation that was discussed in the webinar from Wild Networks has taken place this week. There will be further testing of the implementation and the combination of both the LoRa beacons and gateways and the mesh networking gateways, such that the goal will be to bring this product capability live in the January timeframe, after sufficient testing and calibration of all the measurement tools that they're taking advantage of. But again, addressing one of the other questions here that is been presented about Wild and care homes and the COVID vaccine, the Office of National Statistics, the UK Office of National Statistics, have really brought home something that is important to understand why what Wild Networks is doing is really relevant now and for the foreseeable future. And in that 30% of the deaths, the 48,000 deaths in the UK, we're at care homes from COVID, but also if in the care homes. 14 of the 14,000 reported deaths that were influenza, not COVID, 15% of those, were at care homes as well. And these were at care homes where everyone was vaccinated. So the importance of what Wild's network is doing in the area of covert tracking, we think will continue to be of great relevance in moving forward. And we think the satellite capabilities, particularly in the new transaction that we announced with the major European satellite company, will again be game changing in terms of the ability to have a small device access the internet through the satellite capabilities of the LEO constellation that this company is putting together. So again, Wild Networks is positioned for growth, and we're really pleased with the acceptance of its technologies. And lastly, Talking Medicine. And Talking Medicines is a business about really capturing the unstructured voice of the customer or the patient using advanced technologies. And as the new investment, I want to go into a little more detail into what the promise of Talking Medicines is all about.
It's probably worth me just jumping in here. I'll just say.
Yes, I'm sorry. Yeah, but before I do that, can you, Sarah, provide some insight into the percentage holdings and the net asset value of these companies?
Yeah, no, thanks, Al. What I was just going to touch on is really just give a little bit of insight into how we value our investments. As Al touched on, obviously we are an investing company, not an operating company. So our investments are their results are not consolidated within our results. They sit on fair value on our balance sheet, and those are the fair values that you see on the right column, the NAV for as at June 2020. Now, these fair values are calculated twice a year for our interims and then again for our final results. And so these values have to be audited, they have to be in line with accounting standards, and they have to be verifiable. And there's not readily available market values for private companies. So when we assess fair value, we tend to look at either the cost of investment, if that was relatively recent, or a third-party valuation that's achieved via a fundraise. So, for example, the syndication at Fundamental last year, now that included third-party investors, and therefore that kind of unleashed the value that we'd created up to that point and resulted in a fair value uplift. So it can mean that value that's created over time does not immediately flow through into the fair value, because it's just there are points in time that we look at fair value and assess what is appropriate. Like I said, those 2 points during the year.
Thank you, Sarah. And now looking at Talking Medicines, from an initiation perspective, the problem that Talking Medicines is addressing is one of really understanding what is happening with the utilization of a particular medicine, a particular drug in the marketplace. And the market here is really focused initially on the pharma businesses, of which the overall all-in marketing spend of these companies worldwide is in excess of $30 billion, with about $6 billion of this $30 billion focused on addressing the doctor-patient relationship. What Talking Medicines is all about is providing the pharma company with the capability to listen using social media as a background to the voice of the customer in ways that they could not and previously had no access to improve the product development, the product utilization criteria, as well as to gain further access into the understanding of how a patient is really using one of their products in the marketplace. For example, some patients will start taking a medicine and then stop taking it because they feel better, but not realizing that the full effect of the medicine requires another 14 days of medication. And as a consequence, have a bad outcome, and that bad outcome causes a complete change in the way that patient is looked at moving forward. Talking Medicines is basically looking at the idea of social listening, like companies like Brandwatch before created the ability to provide marketing sentiment in a general sense, but with a laser focus on the drug utilization and drug experiences by customers using social media, but also using advanced capabilities of AI, artificial intelligence, machine learning, which is critical in terms of utilization of the data installed in the databases of drugs, and most importantly, natural language processing, the ability to translate questions from the drug companies into actionable questions and queries that can be ascertained by going into Twitter, going into GoodRx, for example, and looking at the sentiment and the comments and the ratings of drugs and ratings of their experience with drugs for those businesses. So Talking Medicines is providing a brand new capability, the first of its kind, specifically designed for the drug industry, for the pharma companies. And to make a simplistic sort of reference to this, it's very similar to what you probably have experienced if you're an Uber user. There was Uber, and then they created the Uber app, and the Uber app really, with 5 stars, changed the way Uber drivers take care of their customers, as well as the way Uber passengers respect and deal with their drivers, with the idea that by participating in this application and the scoring, confidence in the driver and confidence in the driver's ability to pick up a passenger has been changed. And this is simplistically, addressing a very complicated customer product provider agreement services capability, but doing it very much in that kind of style. So in terms of what to look for and how we want to progress at the company, it really is about establishing this beachhead by connecting the drug companies to their patients and translating to be simplistic again, Latin type words that the drug companies and the doctors use to English questions that can be sourced through social media, and providing those answers back to improve the way those drugs and those drugs are deployed and prescribed and used in the marketplace. The next phase of development for this company is really going to then taking this capability and applying it to the pharmacies, the chemists, who are really facing increased competition from people like Amazon, where the importance of you as a customer coming into their store and walking to the very back to get your prescription is revolves around the fact that the average footfall generates about 30 pounds in revenue for every prescription visit that's created. So creating a better user customer experience with the chemist and the drugstore is something that we believe is going to create additional value within the framework of what Talking Medicines does. And then broadening the platform further is really into the healthcare insurance businesses, where insurance companies, particularly in the US, are very, very dogmatic about pushing everyone into generic drugs. But generic drugs are only 70% by law of what the original drug that was prescribed contains in terms of its formulation. And there are a considerable number of adverse effects, allergies, and things that are created as a consequence of those capabilities. We believe that through the use of Talking Medicines and its data platform, we will enable customers of these products to demand more from their doctors, as well as doctors to demand more in terms of adhering to their prescriptions. So we see a balance of reducing the overall risks for the insurance companies, but also creating better actuarial tables and better capabilities for their customers. And then the idea of the model innovation is really just to bring risk sharing from the customers to the insurance companies and the pharma companies together in one platform. So this is a business that with a laser focus on an industry that's one of the largest industries in the world. The pharmacological businesses growing at a double-digit CAGR, and deploying some capabilities and technologies in machine learning and AI natural language processing that are novel and unique, and also novel and unique such that they're able to be shared with the rest of our portfolio. And we're looking forward to being able to bring some of those capabilities to what we do. So now, well, we'll just kind of go to what we do and how we do it. And I think what's important is we are investing only in high growth markets. We're really looking at healthcare and IoT in use in high value industrial world is where we look for companies and look for deal flow. And the reason for this is twofold. One, the largest installed base of devices and applications that use those devices are both in these two key areas. So as an investment and wanting to create shareholder value, being in markets where that are high growth markets, but where there is a considerable amount of investment already in product, and trying to make those products better, safer, more usable, is why we're investing in this segment. The second reason, to quote a famous U.S. bank robber, Willie Sutton, is because that's where the money is. If you look at the deal flow here in this segment, next slide, please. The majority of all acquisitions in the last 2 years have been in the manufacturing IoT segment and in the healthcare segment. So the idea behind why we're investing in terms of the large install base, I think is also seconded by the fact that the large companies who are looking to change the way their revenues are generated or change their technology portfolio is being accomplished by the acquisition of these young startups, these unique disruptive companies that are creating capabilities for the marketplace that they can't create in the same timeframes to address the opportunities and make them acquisitively accretive to what they do. So we believe the two areas we're investing in provide a great area for growth as well as a great area for investment. Now, let's take a look at what this means for you as shareholders, because I think, as shareholders, as from a management perspective, our alignment is with you. From a wish list perspective, these are, again, the large growing markets, and our value proposition is helping those companies become part and parcel of the U.S., in particular U.S. global market that creates capabilities for growth that span digits that are exciting in terms of their capabilities to become big companies. We also, from an investor point of view, look at companies that have IP that is defensible, positioned with barriers like patents to entry. So we don't look at generalized kinds of solutions, but we look at solutions that provide capabilities for investment protection through the use of patents or trade secrets, or a combination of the both. And then for acquisitive growth, the whole strategy here is to start to create over time a flow of acquisitions of our portfolio companies that will provide us with the capabilities to make additional investments in new businesses as we mature our model. And lastly, we look at companies to invest in that have really strong management teams. We invest primarily in the management team, and then work with those companies to generate additional resources to strengthen the team, strengthen their global capabilities to become leaders in their market categories. And then lastly, we're focused on cash generation and dividends for realizations. To date, we've had 2 exits, small in the material cash delivered back to Tern, but significant in the companies that were participating in those acquisitions, because these acquisitions help generate deal flow for us. So our first exit was with our Flexient company, with a product that we had developed with Flexient in the marketplace, and the exit was to Ingram Micro, the world's largest distribution company, in the billions of dollars in revenues. And most recently with Seal Software, one of our early minority investments that was purchased by DocuSign, a world leader in the marketplace. So these 2 exits help us in terms of deal flow to create credibility in terms of what we promise to our investee companies as to the capabilities that we can bring to them for success. And how we look at investing is really around a simple thesis that we're looking at proven UK software companies. We're really looking to companies that have a product or a capability that is proven with customer acceptance and customer market validation in the areas of IoT, particularly security and applications enablement and data analytics, which is reflected across our portfolio. We invest early stages of seed, late seed, and Series A rounds, with values up to 10 million. So we're looking at deals that have potential upside because we're going in early days and providing the growth characteristics and proof points that will enable the follow-on investments to be at a much higher value. And we do that by taking board seats, particularly the chairman seat, and using that as a way and means to influence the business and provide the capabilities to generate additional value and globalization of the business. And then once we establish those proof points, create a syndicated environment so we can unleash that accretive value that was created in the business, with the idea to transform the business for trade sale or an IPO at some point in the future. From a shareholder point of view, what we're doing here is just this, but we're also providing an additional benefit from a shareholder perspective, and that is, we're getting our shareholders access to investments that they wouldn't generally find on AIM, and we're also providing those companies and our investors with the opportunity to have direct access, because we're placed here in Silicon Valley. We have resources in Silicon Valley as well as in New York and in London to participate in the ecosystems that are acquisitive, as well as are part and parcel of providing strategic help to these companies. And then how we help these companies really revolves around three simple areas of work, but that are very complex in terms of creating value, and that is operationally. We look and work with our companies to professionalize the base business models of our organizations, and where necessary, we add talent to augment what was there from the original management team, not to replace management teams, but to augment those management teams with organizational support from people who have long experience and or successes, particularly prior successes in creating value and these sorts of businesses and markets. And then once we stabilize the operational aspects and the talent pool, really start pushing hard to gain capital through the acquisition of customers and customer growth in the marketplace. And I think, Sarah, could you just highlight some of the things that we've done here in particular in this area?
Yeah, absolutely. I think what's worth touching on really is the direct involvement we have with these businesses, and that's primarily via our investor directors. We have at least one of us on every board, working really closely with our principal portfolio companies. But the executive team, as a group, we talk daily, but we meet formally once a week to discuss the portfolio companies, to look at the opportunities they come up against, the challenges, and discuss what's happening over the next week with them. And that gives the benefit of the whole kind of team input and the diversity of kind of skills that are within the team being fed through via the investor director and back into the companies. We do at times make changes to really for the benefit of the businesses, the underlying portfolio company businesses. As we've seen that recently with Matthew Sherber going on as chairman for Device Authority. Now Al is still staying on the board there as an observer, so actually Device Authority now has the benefit of both of their experience and their skill sets as they to support with their growth plans going forward. And then obviously Al has moved on as well to be chairman of Talking Medicines in addition to that. Now, if I move on and look at key metrics, now the value of the investment company, the portfolio, the 19 million you see there for June 2020. Now that's really an aggregation of the fair values that we talked about earlier on in the slide deck. And as in terms of our net asset base, that the investment portfolio really does make up the majority of that. Now, even though there was no syndication event in the first 6 months, we still see a 7% increase in investment portfolio from the 2019 year end. and that was predominantly made up from follow-on funding into the portfolio companies, as well as an increase in fair value from Device Authority. Now, Device Authority is valued in US dollars, and therefore we do see a fluctuation in valuation if there is a movement in the exchange rate. And in the first half of this year, that worked out with around a £700,000 uplift as a result of that. And so you see that actually feed through into the movement in the profit and loss before tax. If you look at the 6 months to 2019 compared to the 6 months to 2020, again, there's roughly a £700,000 difference, which is predominantly this exchange rate movement. The underlying burn rate stays relatively comparable across the periods. And obviously within that burn rate, there is, our director's remuneration is part of that burn. But it's really worth calling out the fact, we're, as Al's already touched on, we're shareholders in the company, and therefore our remuneration within that burn is really focused on value creation. So we have non-contractual bonuses, which are performance related, and our basic salary is actually in the bottom quartile when we benchmark against other AIM companies. So what we're trying to do with that is actually making sure that our interests are really aligned with that of our shareholders. Now, moving on to look at the KPIs of the underlying portfolio companies. Now, what we try and do here is that our portfolio companies themselves are competitive businesses, and it really isn't possible for us to provide detailed financials by business. Their competitors don't need to do that, and to do so would really put them at a disadvantage. But what we're trying to do is give some view of the underlying performance of the overall portfolio. So where you'll see there, the increase in turnover portfolio, this is our principal portfolio companies. So it was 4 at the time of June. That will become 5 for the year end at least. And that 62% was really for the 6 months in 2020, which we were really pleased with as a result, because it did include a period of great uncertainty, with obviously COVID started to have an impact from March. And then the increase in employees, again, it's pleasing to see an increase to support that business growth, but actually there's real prudence coming through there as well, with a time of uncertainty, and making sure that the burn rate is kept under control and the employee growth is managed, and that's what you see coming through there. And then the net asset value per share has stayed pretty stable between the period. So then, when we summarise this, it's looking at our strategic objectives really are focused around driving shareholder value, and that I pull out kind of 4 areas that's focused on. One is in portfolio diversification, so you'll see that slightly with the Talking Medicines coming on board recently. They're synergistic to the overall portfolio, but there's also in terms of the synergies, we meet as a board with all of the CEOs of the portfolio companies on a fortnightly basis, and that's really to enable everyone to share views, to talk about the metrics that are going on in the market at the time, to really leverage the synergies that come between the businesses, and particularly when they're talking about the technologies and their strategic partnerships. Those meetings actually started, they grew out of COVID, but they've continued and become a very good value proposition for the businesses all coming together. I think there's quite a lot gained from that, and I can see that continuing into the future. Obviously, we're focused on creating net asset value and net asset value per share growth. Again, as we've touched on, that is often really driven by syndication events, which enables us to kind of unleash the value that's being created. Again, that was seen really with Fundamental back late last year, where that enabled a fair value uplift to come through into our results at that point. Now, if we look at expanding the co-investor network, that's really talking about bringing in new financial and strategic investors into our portfolio companies to add kind of expertise and skill, as well as de-risking the portfolio. Again, pointing back to Fundamental, we saw that come through with Financial, with Downing joining the investor group, and then with Strategic seeing both Mayo and Masana hospital groups actually join as well. And then finally, really, we're obviously trying to aim for realizations, as Al touched on. That's predominantly through probably through trade sales, but also IPOs are a possibility as well, if in the appropriate time or with the appropriate opportunities. So on that realization point, there were a number of questions that came up, and it was really to note that the board will really assess the best way to return profits at the time of a realization, and kind of balancing requirements of the business. So what the board will do is look at retaining some funds for reinvestment, distributing some funds to shareholders, and then remunerating management on an equitable basis. And all of that will really depend on the outcome at the time. In terms of the remuneration for management, any management remuneration will really be governed by the Remuneration Committee, which is chaired and run by our independent directors. And again, it's worth kind of touching on the fact that there are no contractual bonuses for management on a realisation. So with that, I think that's the really run through of our presentation. Really over to Tim to manage some questions for us.
Well, thank you very much, Sarah, and thank you very much, Al. Very interesting presentation. I think we managed to hopefully cover many of the questions that people have had. We've had a number of attendees busily typing away while you've been presenting. I've managed to answer one or two of those directly, but we have had some questions that I think it's well worth putting to you. The majority of those relate to specific questions on the portfolio companies, and I think people are interested to know in a little bit more detail about some of those. So if you don't mind, I will go through these in no particular order, because I've just been jotting them down as people have been typing them in. But the first one deals with synergies between the portfolio companies. You talk about trying to generate synergies between them, but somebody specifically asks, Device Authority and Wild appear to offer complementary products. Are there any plans to combine their offerings into some form of combined solution?
I'll take that one, Tim. That's a really good question, and I think the issue here is there are synergies between the businesses across the board, and Device Authority, because it provides a horizontal platform, touches on every one of our companies, because product lifecycle management is a critical attribute, particularly in the IoT space. The overlap or the synergies between Wild and Device Authority are stronger, and no doubt about that. But I think the idea that we would like to employ here is, where appropriate, share those technologies through some licensing process. For example, with the patents within Device Authority, a use license for those patents, or a license for the use of Keyscaler on a white label basis within the nature of the Wild Networks product delivery into the marketplace. This provides the shareholders with a greater upside potential, in that there's a utilization as a customer, rather than a combination of these two things, and working to de-risk and manage all the ancillary effects from that kind of a transaction. So I think looking forward, what you'll see in terms of synergies being exploited, it'll be through use licenses and/or just general white labeling licenses of the technologies between our companies, to facilitate accelerating their differentiated value in the marketplace.
Okay, thank you. Moving on to Wild, we've had a couple of questions regarding Wild's IoT satellite offering. Could you explain in sort of simple layman's terms exactly what this is and how it operates, both from a technical point of view in terms of implementation, but also what it delivers for the user?
Okay, I think I'll take this one as well. In very simple terms, if you're used to flying on airplanes, jets, particularly across the globe, they all now provide Wi-Fi access, and that Wi-Fi access is brought to you by geo satellites or geosynchronous satellites that broadcast to the airplane. And if you look at the airplane, and you'll see this big bump, probably about 6 foot in diameter, that sits on top of the plane. That's the antenna or the receiver for the satellite signals to create this internet capability. what Wild is doing with its satellite products is working with low Earth orbit satellites, constellations of 25 to 50 satellites, creating a communications capability to communicate internet access, and doing so, but not through a 6-foot bump on the top of the airplane, but by having created a small radio receiver that can fit within handheld devices, for example, that can access satellite information or access the internet through the satellite access provided by these LEO low Earth orbiting satellites. So a great example is creating a capability for precision agriculture, where, again, coupling it with mesh technology, tractors on the field can transmit information about the quality of the soil, the liquid capacity of the soil, the fertilization of the soil through the tractor to a beacon that has one of these antennas, these receivers, and distribution capabilities back to the satellite created by Wild Networks. So the idea with Wild is to provide very low cost, very affordable, small radio receivers and transmitters, and more importantly, the software stack that drives that capability to these low Earth orbiting satellites to bring internet access to places where internet access just isn't available, or companies like BT won't spend the money to bring the fiber and the capabilities to have high-speed access available to those places, as well as in the third world countries where there is no capability whatsoever today. So Wild is, I think, uniquely positioned with its new capabilities with these new radios to transform internet access globally.
Thank you. Moving on to MVNA, I've got a question here. 50% of MVNA was required in 2017, but the question says, since then we've had very few updates regarding this investment, and specifically, has it lived up to the board's expectations, and what stage of development is this business actually at?
Well, do you want me to answer this one then? I think Al touched on it a bit earlier, saying, the MVNA is making great progress at the moment. It has taken a little longer than probably anticipated when we first invested, but they have now repositioned themselves from a consultancy to a SaaS, product business. And again, they have that significant industrial distribution partner that they secured, and we announced earlier this year, and that really kind of established it as a kind of acceptance within the industry for Asset Minder. They now have a new CEO on board who's very experienced and has a great drive and vision for taking the company forward with its growth plans. So the board is completely supportive of Peter in his new role and the strategy he is following, and he has come and presented to us, and and been very impressive doing that as well. Now, I would say within stages, it's very much sitting in stage 2. That's the kind of growth and commercialization, I think, is exactly where I position it. Okay,
thank you, Sarah. We've had, Al, I think these ones are for you, a number of questions on device authority. Really, I've tried to sort of simplify them, what people have been asking. Really, it boils down to device authority has spent a lot of time and effort, obviously, engaging with Microsoft over the last few years. Personally, what extent do you believe that DA's offering is a nice to have add-on, i.e. one of several competitors offering similar sort of offering to the Azure platform, versus actually being essential and unique?
Well, I'll go beyond a personal view, but but look at it from an industry perspective. The COVID situation has created a banquet for bad actors around the world to exploit and create problems that heretofore haven't been seen or dealt with. Just this morning, I got a note through one of the organizations I participate in and on security that Netflix has become the number one target for creating issues that take over people systems. But more importantly, universities and large organizations and hospitals have been put in situations where they have been faced with incredible ransomware. Most of these aren't really discussed because they're ransomware and they don't want to encourage further ransomware attacks. But all revolving around existing implementations of existing products, using over-the-air updates or other mechanisms that cause vulnerabilities or an expansion of what in the security world is known as the attack surface. So device authority is uniquely positioned to stop these sorts of infiltrations and attacks. And what's more important about what device authority does and why it's relevant and not a nice to have, but a must to have, is as you start to deploy these things in scale, trying to rely on humans to create the capabilities to protect devices is fraught with risk because humans make errors. And those errors are how things are exploited. The device authority product, particularly deployed in a hybrid cloud like Azure, eliminates human error, provides for an automated way of providing secure lifecycle management of the product linked to an application, such that the attack surface is reduced in old products close to zero, and the new product designs to zero with the utilization of the device authority's Keyscaler product. So it's a product that, again, as these deployments become more and more prevalent, spins up in its value and spins up its importance. But our relationship with Microsoft is expanding. We've moved from starting in the DPS area to now in the Sphere area of their hybrid cloud strategy. We're working diligently with them in the marketplace. And again, the relationship is generating new leads for the business and new customer acquisition of sizable organizations that are long-standing Microsoft customers. So I think we have a product in Keyscaler that is very relevant, very important, and strategic to providing companies with the ability to protect their assets.
Thanks, Al. A follow-up question that might be slightly more difficult to answer, but given this progress, can you give any sort of indication as to how close device authority might be to actually be self-sustaining from a cash point of view?
That's a difficult question because we're building in device authority a SaaS model, and a SaaS model is all about acquisition of customers and the growth of MRR, or the monthly recurring revenue. So contracts, can be created which create deferred revenues, but the actual recognizable revenues and the cash generated from those recognizable revenues, would take some time to grow and spin up to the complete deployments of those products, as well as that getting new customers and bringing those customers on board and accelerating those revenues to annualized revenues of significance is time consuming. And what we're doing at Device Authority is really looking to gain many more beachheads, particularly with our Microsoft relationship in areas of high growth, so that as the business grows with these big companies and the deployments increase, the need for capital will be reduced as we have the stickiness that comes from being deployed in these 5, 7, and in some cases 10-year contracts, particularly in the healthcare area, where we're providing capabilities to be deployed both to existing products and new products. So it's hard to predict, particularly because of COVID, as some of these manufacturing lines have been turned off and some things have delayed, others have accelerated. So I think progress is being made, which is the important thing. The focus is on developing a SaaS business with very sticky revenue, with very interesting 3, 5, 7, and 10-year contracts with organizations, and using our partners' existing customer base as a way to create a force multiplier for device authorities' sales and marketing spend to mitigate the requirement for cash, but nonetheless, it takes cash to grow a business and grow a business to be a big business.
Thank you. Another part of the portfolio, fundamental VR. Obviously, you mentioned during the presentation the Reach announcement that's going out tomorrow. I understand that's in relation to a follow-on order from pharmaceutical client who provided an order in December last year. Can you give us any more color on that? How the rollout actually took place, and any more details about that contract and what the business as a whole is doing, both in that area and others?
I'll do my best here in that this is from an investor point of view, or for further syndication perspective, an important factoid or beachhead that the company has developed with this new order that we'll announce tomorrow, in that it is a repeat order. It is someone who is trying to change their business model, a very large, innovative pharmaceutical business, to accelerate the product adoption of one of their key products in the marketplace. And what's significant about this is it's a procedure. It's the procedure that doctors have to learn in order to use this new drug that requires extensive training, that up until before COVID was relatively easier to do, because they could deploy salespeople to go around and technical salespeople and do the training in the traditional kind of way. What they've discovered with the fundamental is that they can create a capability to not only train using the fundamental platform, but they can create the capability for the surgeons or the doctors in this case to practice and create a capability of comfort before they actually go with a live patient. But also the companies can collect data and understand the performance characteristics of the doctors in the marketplace. So this follow-on order really reflects the value and the power of having this virtual reality platform using haptics to create a capability to accelerate the deployment of this new procedure, the ability for this new procedure to be adopted, and with its adoption, spin up revenues and profits for that organization. And preliminary data would suggest at much faster rates than what was traditionally done with salespeople going around, technical salespeople going around, one doctor at a time. They can address the totality of the marketplace by making this capability available on a registered basis to their potential customers, and create influence in both the marketing of the product, as well as the training and comfort required from the doctor to then utilize the product. So this is a significant order in that it's a follow-on, and the follow-on says they were pleased, would indicate they were pleased with the results of the first implementation of utilization of the fundamental platform. And we're excited about this because it provides a proof point for further syndication down the line.
Okay, thank you. Well, I think that covers all the questions that I've actually had submitted during the call. And I note that we're actually 5 minutes over what was supposed to be an hour-long presentation and Q&A. I recognise that there may be many questions that people have that they would like to ask or think of after the presentation. If you do have anything, please do feel free to contact me, Tim Metcalf at IFC. My email is the best one to use is Tern at investor-focus.co.uk, which you'll find on the company's website, and we will endeavour to come back to you and answer your questions. But Sarah, Al, thank you very much for the presentation, and thank you very much indeed for everybody who's taken the time to watch and listen in this evening. Thank you.